Hi, my name is Jamie Kirk. I'm a Senior Associate in PwC's Risk Modelling Services Department. Today I'm joined by Stephen Carlin, Customer Success Director and Product Owner at Montoux. Hi, Stephen.
Hi, Jamie.
So recently we've been discussing the pricing function of the future, and more specifically, how it can be shaped by new and existing technologies emerging in the market. Until recently, many pricing teams have relied on a simple set of tools to support their pricing. For example, a pricing model, which is typically built on valuation systems, spreadsheets, and other ad hoc tools. So Stephen, I'm keen to get your thoughts on why you think this is no longer a fit-for-purpose approach to pricing.
Well, yeah, firstly, I think what we've seen over the years is pricing teams probably not having the investment that other parts of insurers have had. And that's kind of understandable given the investments that were required for things like Solvency II and IFRS 17. But I think we've started to see that change over the past few years. One of the things we've seen in the UK market is a shift to much more frequent repricing. And as the market has evolved, I think insurers are looking to make those investments to drive that more rapid pricing cycle. And that is both a speed and efficiency thing, but it's also a sophistication of the pricing and some of the methodologies and the techniques that we see coming into play there through the use of things like applying data sciences, using optimization techniques. And I think it's important that insurers continue to make those investments. Otherwise, you risk missing out on opportunities that might be available in the market and maybe concede some ground to your competitors.
Yeah, cool. And what technology capabilities do you think the pricing function of the future will need?
Well, I think there's a few things. I think data is going to play an increasingly important role. So the ability to seamlessly integrate different data sources, whether those are rating factors that you're using on pricing, where it's competitive data feeds, getting those data flows both into the system and then out of the system when you've got updated rates is going to be important. And the use of APIs to make those data transfers seamless, I think will be key. Making sure that data is in a form and a location that is accessible such that it can be pulled in when it's needed, so that it can drive the sort of rich analytics that are going to be required to support some of the processes. I think some of the other themes are as some of the techniques get more sophisticated, that's going to put more stress on computational load, whether that's more runs of the actuarial models, whether that's getting into more sophisticated optimization runs that require many more iterations. So having the infrastructure capabilities and the scalability to be able to pull in those compute resources is also going to be really important. And I think just general automation of the processes, removing some of the manual steps will be really important in achieving, I guess, the level of quality that you need in those processes and the timeliness so that you're able to respond and to market opportunities and turn around pricing updates in very short periods of time.
Definitely. Some really interesting points there. Thanks a lot for your time, Stephen, and thanks everyone for tuning in. Until next time, see you later.